Good afternoon and welcome to Nasdaq Sector Talks. I'm your host Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Jack Menkes, the technology analyst with Nasdaq IR Intelligence. We're going to take a look at some of the earnings that have come out this week. And Jack, I can imagine it has been quite busy for you. We've had a lot of tech come out. Earnings have been good, but not necessarily great.
Right, so we're not kind of on the solid end of really the earnings kind of season. There's still a lot more to come over the next week, but they really haven't been sort of on the underwhelming side that we would have expected. But there have been a couple of software blowout names which have been pretty good performances so far. But I think a big detractor has been semiconductors, and as we're seeing today, Intel has really been dragging down the entire sector. Actually, in their conference call, they actually said that there are actually a number of headwinds just related to their data-centric orders with some of their chips, and as well, they actually CEO Bob Swan said on the conference call that there was a dramatic decrease in business investment from China. So you're getting really just kind of a two-pronged approach when it comes to some of the semiconductor names, and Intel is kind of really dragging the semiconductors, at least for today. So that could be sort of a headwind to look out for in the near future.
The CEO, he's new though.
Yeah, so
perhaps it could be a little bit of.
So there might be some more Intel-centric than more of a secular,
right.
Than more of a secular play. But given some of the other names that have reported so far this week, it's something to look forward to, or to at least look out for in terms of the entire space as a whole.
But it's so interesting that tech really has become the haves and the have-nots, which is very typical of retail. But if you're in software or services or enterprise, like Microsoft and Amazon, that seems to be the sweet spot right now.
Exactly, and so what we actually saw last year with semiconductors is we actually saw sort of a double ordering taking place in the first half of 2018, which kind of led to some of the softer numbers that we saw in the latter half of 2018. Which kind of led to some of the Q4 drawdowns for some of the semiconductor names. So I think that's really going to be something to kind of look out for at least for semiconductors in the short term. And just given kind of the dramatic increase in the space as a whole, there's going to be some expected pullback.
I mean, tech, look at this chart year to date. I think you have a stat here climbing 1.5% on average every week.
Yeah, and actually there's you'll see like one little kind of small blip on the chart there, which is kind of just 1 week, which was actually the first week of March, was when we had the sort of the underwhelming February jobs report. But really, it's been a dramatic increase every single week, and like you said, it's been a meteoric rise by about 1.5% each week. And you have to think that there's going to be some type of a pullback, and especially given some of the semiconductor softness today. This is an unsustainable chart to if taking the whole realm into consideration. But like I said, there's still more earnings to come, so we're going to kind of have to take the entire space into consideration when looking at this.
All right, so I mean, more room to run here, or like you were saying before, there could potentially be some profit taking, but you also point out these flows are continuing to go into these growth stocks here.
Yeah, so I think one thing that investors are really kind of pricing in is the lack of is the Fed just really not implementing any more tightening of monetary policy, which is really just going to allow just a free flow of capital into business investment, and that should really kind of drum up a lot of growth, and especially we're seeing a lot of investment into the growth names for sure. But one economic report that came out today was the GDP number, which was a fantastic blowout number, 3.2% on an annual basis. I would not expect that to be sustainable either. And actually one interesting number to actually note in that is the non-residential fixed investment number, which was actually only about 2.7%. And that was actually a 50% decline from about the 5.4% rate that we saw in Q4.
Right.
So that's, the fixed investment really relates to investment into software and R&D. So that's just something that, maybe could drive some of the secular headwinds for the near future, and just given the rise again 1.5% every week, that's not going to be a sustainable number in the near future, and we're actually seeing a number of stocks kind of entering into overbought territory. So you have to imagine that there's, at least in the short term, maybe going to be some type of pullback, especially with the sector reaching at all-time highs, and the indices also, major indices reaching all-time highs. So there's going to be maybe a little bit more of a pain in the short run, but long-term prospects are still pretty good.
All right, Jack, thank you so much for joining us at MarketSite. And thank you for joining us on Sector Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.